I think markets are certainly kind of well priced, but I don't know that it's to the point of exuberance, right? I do think some of the key things that investors and markets are focused on today is number one is inflation moderating, giving Fed the confidence to cut rates a couple more times. Number two, is the global's earnings growth momentum that's really driven by AI, robotics, semiconductors, is this strong enough? Will it continue to offset some of this softness and weakness in some of the other sectors? And lastly, it's really around government, right? Just are there continued regulatory easing, pro-growth fiscal measures, and lastly, some tariff relief. And so I think investors are really focused on these three key areas, and if these three key areas continue to surprise to the upside, then I think there is still another leg of a rally left in the market. And just two last points there is, I think investors are also watching closely kind of a rebound in emerging markets in China, as a lot of the global demand is sourced from those regions. And lastly, investors are really looking for a bit more of a balanced, kind of rally, right? Today, just in the past couple of years, it's really been driven by kind of tech mega, stocks. And so I think this is kind of the state of the markets today.
Yeah, but rate cuts are coming. AI is there to perhaps support productivity.
Yeah.
We're off the, hopefully, tariff-related uncertainty, then things are okay when it comes to public markets. But what you said at the panel on private markets earlier this week, you said in the second half of this year, you see pockets of some overpaying in private markets. So how does that work together?
Sure, absolutely. I think whenever you have an exciting megatrend in front of you, like AI, I think when you take a look back at the turn of the 1900s, right, when the Ford Motor Company was founded, there was probably several hundred, if not 1,000, different car companies that came to being. And today, only 3 or 4 of those companies made it. I don't know if it's 5 or 3, but a very few amount of them made it. And so I think we're kind of in a similar period, right, with a lot of these, AI companies being formed. Obviously, there's different layers to kind of this, episode of AI kind of revolution that's coming. But I think, especially on the app layer, it's very difficult to be precise around who's going to win and not. And some of the valuations being paid there, I think the market will acknowledge that is very, very high.
We were joking earlier this morning, right? Because she was telling me about how she was talking to you on your panel and how yourself and some other folks involved in the private markets were getting excited or optimistic about the fact that rates are starting to come down. Because it's been a tough couple of years for private markets, right? But with rates coming down, maybe the prospect of quicker and better exits, IPOs. In this case, though, we've got the U.S. government shut down yet again. Depending how long it drags on, right? It's going to make the SEC's job a lot harder. It could delay IPOs as well. Does it concern you?
Yeah, look, I think when you look at history, the past 50 years, I think there's been about 20 government shutdowns. 17 of them just lasted a few days, right? 1 to 3 days. And only 3 of them lasted, anywhere. I think the longest one was about 35 days, right? And so,
Trump won his first term,
Right. And so I do think a lot of, investors are watching kind of its kind of the duration of the potential shutdown and its severity, and just looking back at historical market data, the stock markets usually weren't impacted, right, by it. And I think there's just a broad acknowledgement from investors as well. It's, it's difficult to underwrite, some of these things. And so I think it's a bit more of a wait and see and reactive approach as opposed to trying to underwrite exactly its impacts immediately.
So talking about duration, TMRS, 220,000 members, 943 cities, 40 billion trust fund assets. About 5 billion of that is in private, right? Which is about, I think, back of the cocktail napkin math, about 12.5%. When I take a step back and look at pension funds, I think this kind of looks like an insurance company in a sense, right? Because you've got a lot of long-term liabilities, and you probably hire a lot of people with degrees in actuarial science, right? Private investments, You're at 12.5%. Are you comfortable with that, or does that need to go? Do you want that to go up?
Yes. So we are. So just broadly on our. So just to answer it directly, that number is coming up, right? And so across private markets, we're actually closer to 40-45% today. So that encompasses private equity, private credit, and real assets. In private equity, we're about 12%, and our target is increasing to 20%, right? And so I think when you look at our strategy from a very high level, on the public market side, we're largely taking a low-cost passive approach, right, to market returns. I think it's very difficult to beat market sometimes, right, on that end. And even if you are incredibly good at selecting managers that outperform, you only get the difference between a median investor and a top 5% investor is about 3%, right? That same number in privates can be 15 to 18%.
Right.
So you're much more, you're better compensated for being good selectors of fund managers and of deals in private markets. And so that's really where we're trying to find a lot of our outperformance, and also engaging in direct co-investment activity. So working with our partners to source deals and select deals on a thematic orientation is a huge priority for us.